Hello, everyone. Welcome to Wall Street from Main Street podcast. My name is Mo Daoud, and today's special guest is Gail Tverberg. She's the author of Our Finite World, and she also has a blog where she writes about the oil market at www.ourfiniteworld.com. Gail, thank you for joining me.
Well, thank you for inviting me.
Well, today I wanted to talk about the oil market with you. And before we get into the oil market, I want to talk about your background and talk about how and why you started to do research and write about the oil market.
Okay, my background is really in insurance and in mathematics. I'm an actuary by training. And so I had worked in insurance for a long time. I did forecasting kinds of things. So I had been fairly much involved with how, I can't say financial markets so much as financial projections work and such things. And I heard back in 2005 about the oil problem. And I thought, well, that's something I'd like to investigate a little bit further. And then I discovered that there was quite a bit to it and that the people who were involved with it were not necessarily understanding the full story. So I got more and more drawn into it. I got invited to help with a group website called the Oil Drum, which is now defunct. But anyhow, I have my own site, Our Finite World, now.
Oh, that's very interesting. So you have written and researched for the oil market for how long?
Well, it's been since 2005 I've been involved with this.
And there's a lot of stuff has happened between 2005 and today. A lot of up and down in the oil market, a lot of geopolitical and economic events that impacting the economy and people's lives all around the world.
Mm-hmm.
So I want to shift gears here and talk about what's going on in the oil market. A lot of activity that's happened this week and also in the past year or so. Oil prices have been in a downward spiral lately, with oil prices as low as $26 per barrel a few days ago. It had gone up the past 2 days by about 21%. Now, a lot of people think that the low oil prices would be a good thing and would stimulate the economy, since the gas prices will be low and input costs will be low. But that hasn't been the case. Why do you think that is?
Well, I think the basic issue is that the companies that are trying to produce oil can't really produce it for the low price that it's selling for now. They really need very much higher prices. And even countries like Saudi Arabia and other countries in the Middle East need the high prices, not so much to get the oil out of the ground, but to provide the tax money that is used to run those companies or those countries. And so even they have a very difficult time operating with these extremely low oil prices. The situation is just not sustainable at all.
And also, the IMF has come out and said that if the oil prices don't go up within 5 years, and if Saudi Arabia don't cut government spending, they could go bankrupt.
Well, right. There's probably a lot of other pieces of the system that could break as well.
Yeah, and I read somewhere that Saudi Arabia needs at least $100 in order for them to break even in their fiscal budget.
Right. That's what, when they talk about the fiscal break even, that's when they're taking into account the tax money that Saudi Arabia really needs. And I would agree with that.
And then the other oil countries like Iran and Russia and Venezuela that need even higher oil prices in order to break even, in their fiscal budget, which tells you how dependent a lot of these countries are on oil, and which tells you why oil is very important and probably the most important commodity in the world.
Well, oil certainly is used in, our cars and trucks and construction equipment, and also it's used in many other ways, of course, making roads, making pharmaceuticals, making fabrics, making chemicals of many different kinds. it's hard to imagine how we would get along without oil.
Now, let's stay on the topic of Saudi Arabia. They have recently commented on the oil market, and they believe that they can handle low oil prices for a long time. What is your take on that?
Well, Saudi Arabia can probably handle low oil prices for longer than quite a few other places can. But as you pointed out, in 5 years they can't do it. You know, they are cutting back on their subsidies for, say, fuel prices right now. The population's not going to be very happy about it. I think there's going to be indirect effects. They're probably not buying as much from world markets either, so they're part of the demand problem in some sense as well. So in some sense, Saudi Arabia can get along for a while. Maybe it's 2 years, maybe it's 3 years. But there's so many other places that are having real problems, and that's going to be a problem.
And you can see what's happening in Venezuela right now with their social and economic structure completely breaking down, and a lot of it has to do with the low oil prices.
Exactly. And I was reading about Argentina this morning. You don't think about them because their own oil production is way down, so they're not really an exporter at this point. But I think the low oil prices are hurting them as well.
Now, you've been studying the oil market for almost a decade. Now, when we have low oil prices, a lot of people start assuming that they'll start shutting down oil wells and stop drilling and stop working on expansion and construction on oil wells onshore and offshore as well. How long do you think that when the oil prices go down, how long do you think it takes for the oil market to adjust the supply side and start shutting down the oil wells and the oil drills? Is that something that happens automatically, or that just takes time?
Well, it doesn't happen nearly as fast as you would think it would happen. What happens is all of these companies realize that they have to have some money coming into their company. And they already have drilled a lot of wells, so they're going to keep those wells going. And if there's any areas that they can drill that would have very good payback, they will work on those as well. So they're going to try to keep production up if they possibly can, as long as they can. And even if it's something like stripper wells or something that's been out there for a long time, there's costs associated with turning them off and turning them back on again. And so they're not going to just run out there and turn them off. They're going to say, well, it's down, but it's going to get back up there. We might as well just continue, leave it the way it is. We'll get what little revenue we get from our wells, and we'll leave things alone. So companies tend not to cut back production. And of course, they very often have debt that they have to repay. And the fact that they have debt to repay means they need cash flow to repay that debt, and that gives them further motivation for not cutting back.
That's interesting insight, because there's a lot of people out there that actually think they can just turn it off and turn it back on and turn it off and turn it back on when the oil prices fluctuate. There's many factors that goes into when a company decides to shut off the well due to external factors that's out of their control, such as the oil prices. Now, you've been studying the oil market, as I said before, and let's focus on how the private oil companies have managed the low oil prices environment. Companies like Chevron, Exxon, and all the other smaller and bigger oil companies. In your research, how do you think they've been handling this low oil prices, and what have they been doing to try to weather the storm?
Well, I think one of the big things they've been doing has been borrowing as much money as they can to, say, pay dividends, and at the same time they're cutting back on new investment, and especially things that might be farther away or more costly, they're cutting back on. Any kind of projects that they already had underway. If they've got a 10-year project and they're 8 years into it, they're going to keep on going and keep it coming so that new project may still come along. But they've been trying, they cut back where they can, but they, at the same time, they keep their production up. One thing I didn't mention before that I might have mentioned was that companies very often have derivative contracts that pay them a higher amount than the market price. So many of these companies, even if the price dropped from $100 a barrel, they probably still had derivative contracts that paid them a higher amount. So it didn't really affect their bottom line right away, and they had some breathing room. So that was another reason they didn't cut back.
Yeah, I know Chevron has announced that they're going to cut their expense by 25% in 2016. They're focusing on balancing their balance sheet by selling assets. They haven't cut dividends yet, but that's probably their last resort right now.
Yeah, I would say cutting dividends is their last resort. One thing I didn't mention before was laying off workers, of course.
Oh, yes, that too. And we're seeing big oil companies lay off people as well. One major oil company, forgot the name, has announced 10,000 people will be laid off. Probably have to due to the low oil prices. So it's a very tough time in the oil industry right now for the people that work there.
Exactly.
So I want to talk about something that you wrote in your blog. You said that we are at the end of the debt supercycle. Now, how and why do you think that is?
Well, basically, the way the economy works is that you really need debt if you're going to add new oil supply or coal supply or natural gas supply. And it works in several different ways. It's partly because it may be used just by the company itself drilling for oil, although that's not necessarily a big need. They might not even use it at all. The places where it gets used especially is for the consumers, buying cars or houses that use oil in their production, in their manufacturing. And also the debt comes into place in all of the factories that make the cars or make the goods that go into the houses, for example. So a lot of debt is built up, and when the price of oil is low, it doesn't take very much debt to get the economy going. And so you can keep the economy going pretty well when the prices are low. The price of production of oil is low. But as the price of oil gets higher, then what happens is it takes more and more debt. Some of that debt ends up going into the oil extraction just because it's so costly to extract. But then what happens is your price of your car goes way up, the price of your house goes way up, the price of the factories goes way up, and so you get very high debt and you get this big bubble. And at some point it becomes too expensive relative to the wages to pay back this debt with interest. And a big part of this has to do with wages not rising very rapidly, especially wages of, say, factory workers or truck drivers or some of the people that you think of that aren't the highly educated people, and they're not the people that are managers or in charge. It's just the ordinary people. Workers are finding that their wages are, barely enough to get by on, and because of that, they're not buying new cars and new houses, and that's part of what brings the prices down.
Yeah, and a lot of the growth in the economy ever since the 2008 crisis has been propped up by debt and bailout and financial stimulus and QE by the Federal Reserve. And now, right now, we're at the tipping point in 2016, and we're seeing that in the stock market that has a lot of volatility lately. And also, look at the sales during the holidays have been down. The discretionary income is down. The household medium income is down. So I agree with you. We're at a tipping point right now.
Exactly.
Now, I want to talk about with the low oil prices, Wall Street has been affected by this as well, since they have a lot of exposure to the loans in the energy market, and a lot of them are starting to default. What impact will the defaulting loans in the energy market have on the economy?
Well, I think that's a good question. What you usually think of as happening is that the banks especially will be affected by these defaulting loans. And I suspect there might be also some derivatives that are affected by these defaulting loans. And that, too, could have a bad effect on the banks. Now, the question is whether the banks would be allowed to go under, the government would try to bail out the banks, or what. What they have said is they don't want to go bailing out companies again, and so what they're going to try to do is do these bail-ins, and if they do bail-ins, then the first ones that are affected are the owners of the banks, and that would be the first layer of protection. But then not too much after that, it comes to the big depositors. And, of course, the big depositors are going to be businesses. And those businesses may have employees. They may be buying goods that they need to pay for. And if the government takes those funds essentially to pay for the losses, that's not going to work well at all.
And that's a great point. And I've heard rumors throughout the internet and through other people as well that the Federal Reserve have told the banks to cover up their losses on the defaulting loans in the energy market.
Yes, I've seen those same rumors too. And we know that that kind of thing happened with the commercial real estate loans back in 2008. We also know that in other countries, say in Japan or China or whatever, I think that kind of thing has been pretty standard to be the case. You know, if some company looks like they can't pay their loan now, what you do is you give them another loan and you say, well, we'll cross our fingers and maybe in 5 years things will be better, and not only will they be able to pay back what they said they could pay back before, but we at least extend the loan we had, but maybe we even give them a little bit more so to see if they can make it through.
And that's a great point. And then it tells you that Wall Street and a lot of the financial institutions have not learned their lesson from 2008. It seems like they're back in their old habit of speculating and doing reckless things, and they're expected to be bailed out by the Federal Reserve, so they continue to act careless, unfortunately.
Right, and I think the problem with the Federal Reserve is it did so much before, with all of the QE and such things, that it has a lot less it can do now because it's already, lowered interest rates about as much as it could. And even though it isn't extending QE anymore, it still is obligated, the way it's doing things, to keep buying more treasuries and such. So there still is a kind of an ongoing QE. It limits what more it can do.
And yep, I agree with you there. I think it had done way too much since the 2008 financial crisis, and that the role of the Federal Reserve needs to be revised and looked at, because it had not made any improvement in our economy. It has in the short term, obviously, but in the longer term, it looks like we're on the brink of another financial crisis, unfortunately.
I would agree with you on that.
So I want to talk about the private oil companies and national oil companies such as Saudi Arabia, Iran, and etc. Who do you think is in most trouble right now due to the low oil prices? Is it the private oil companies or is it the public oil companies?
Well, I think I don't know that it's an or question. I think they're all in trouble. It's the governments of those countries, the Saudi Arabia and Iran and all of these countries that are in trouble if they can't get enough tax money, because then it becomes hard for them to say build the infrastructure in Iraq, for example, so that they can expand their production. And even Russia needs the oil money to fund many of its programs. So they're in trouble. But the oil companies, big and small, are in trouble. I would say the very small oil companies, the private ones, are especially in trouble. The bigger ones have more to go on. So I think those are the ones that we're going to see the defaults on first.
And it doesn't look like Saudi Arabia is going to cut down their supply of oil anytime soon, since they want to export more and collect more revenue to fund their own fiscal budget.
They need more, essentially, tax money, and
yes.
And so it makes sense for them. Any additional barrels they can ship will help their tax revenue.
Before we end this podcast, I want to ask you one final question. And now there's a lot of technological advances in the alternative energy field. Now we've seen Tesla come out with their battery that claims that can store a lot of energy from solar panels, and a lot of people are coming out and saying and writing that this could be the end of fossil fuel. Now, what is your take on that?
Well, if we had another 100 years to solve our problem, maybe that would be something to look at, but we're talking about a problem in 2016. And I think it's still a very, 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 very long ways away. And people lose sight of the timing differences. And there certainly are cost issues involved as well.
And that's a great point. It remains to be seen if these technological advances will help offset our problem with peak oil and oil supply and trying to cut our dependence on foreign oil, but it's not something that's going to be solved in 1 year, overnight, not even a decade. It's going to take a while, so I agree with you there. But Gail, thank you for your time. And if people want to find out more about your work, where can they go?
My website is ourfiniteworld.com. So you can find my articles on that website, and there's lists down the side of some of my recent articles.
Okay, great. Well, thank you, Gail. I appreciate your time.
You're welcome. Good talking to you.